Well, hello VV Nation. This is Ron Wheeler, manager of options trading here at VectorVest, and it's my pleasure to bring you tonight's special presentation, The Power of Options. So, before I get into the presentation, why options? Why should you learn to trade options as an active trader, an investor, or any type of person that's interested in the market? Well, we're straight from our founder, Dr. DiLiddo, and his 7 secrets to making money with VectorVest. The 5th secret is learn to trade options. And this goes to any type of investor. Whether you are retired, whether you're still working, you're active, there are option trades out there for everyone. And the benefits of options are fantastic. Number 1, less risk. The trades that we do all have a fixed risk. You get more leverage. Instead of taking a stock that's $450 and throwing a ton of money at it to buy 100 or 1,000 shares, we can buy a simple call. We can reduce the cost by doing something like a covered call or even a spread. And with options, we can even build trades that give us more probability. We can make money on certain option trades even if our market prediction is incorrect. Now, a lot of people out there are afraid of options. There's so many things, there's so many terms, and it leaves you confused. Well, our goal here at VectorVest is to teach you to use options the right way. When you do that, you will increase your ROI and you can even use them to generate income. So in tonight's presentation, I want to introduce you to 3 basic options trades that every investor should know. Now, before we get too far into this, I want to talk about some basic option terminology. In the options world, there are 2 types of options. There are calls and there are puts. And you have the option, no pun intended, to either buy them or you can sell or write the options. Now, let's focus on the basics first. Let's talk about buying an option. And in tonight's presentation, I'm going to focus on buying a call because right now the market is a confirmed up and we also have a due up, which is what I use to identify direction. So if we were to buy a call, that gives me the right to buy the stock if I want to at a certain price by a certain date. That is the expiration and that's the strike price. Now, that is the proxy for going long something. If I were to buy a call on IBM, my goal would be IBM moving up. Now, we can also buy a put. A put gives us the right to sell a stock or go short. I can do that at a certain price by a certain date. Again, that's the strike price and the expiration of an option. Now, some folks look at the put and say, well, if I have the right to sell, what do I sell if I don't own anything? Well, if you were to perform the stock transaction by owning a put, you would be forced to go out and buy the stock and then sell it to someone else. Now, I don't want you to worry about stock transactions here, at least for this first part, because we're not going to be performing stock transactions. We're going to be doing this trade solely with an option, which means we're going to identify a stock that has a high likelihood of going up. We're going to buy a call on that stock, and then we are going to exit the trade by exiting the option. We're going to buy the option, and then we're going to sell the option and never actually own the stock. So let's talk about this real quick. First and foremost, let me go over to Options Pro. Now, you don't need Options Pro to do this. This happens to be our VectorVest options trading software, but I want to show you what an option chain looks like. Every option has an expiration. This option is the September 15th, 2023 on IBM, and it expires in 56 days. So when we look at the right to buy and we say shares at a certain price by a certain date, well, there's your date. This will give me the right to buy the stock between now and September 15th when the option expires. Well, the right to buy at a certain price, that's right below it. That's the strike price. So I can say, all right, I want to be able to own IBM at $140 sometime between now and September 15th if I want to. I would simply go out and buy a $140 call. And right now it's trading for about $2.40 between the bid and the ask of the option. So maybe about $2.38. That's where that's trading at right now. If I wanted to go where the stock has already been, I can choose $135. Now the stock's at $138. If I choose a 135 call, this will give me the right to buy the stock at 135 between now and September 15th. Now what you'll notice is that option is much more expensive. It's going to cost me around $5.25, $5.30. As you go and go further what's called in the money, which means the stock price is now above my strike price, the options tend to get more expensive. We really don't want to pay too much for the option. Remember, we want to increase our leverage and increase our rate of return. So what we like to do is we like to buy our strikes near the money. That means try to match the best you can the last price of the stock with the strike price of your option. So as I said, we're going to focus on the most basic options trade there is, and that's just the long call. If you think a stock will go up, you buy a call on that. It has the highest potential profit, and it also has a fixed limited risk. Now, the downside of that trade is you have to be right to make money. If the stock goes down, you're not going to win. Now, some basic guidance on the long call. We're going to target expirations near about 45 days and strike prices at or slightly below the stock price. Now, this is geared towards the conservative, prudent-minded trader. Just like you would go out there and buy a stock with the anticipation of holding it for a couple weeks, this is not meant to be a day trade. This is not meant to be a swing trade. We can certainly talk about that in another time, but this is meant to be more for the conservative trader. Now, what I'm going to do, I'll switch over to VectorVest. I'm going to go to our Unisearch, and I'm going to run one of my favorite scans. Under Searches Retirement, one of my favorite scans is Long-Term Winners RS Descending. So I'm going to click on that scan, and let's just go ahead and run the search for the top 20. Now, if you'd like to optimize this search, I'm going to show you a few optimizations that I personally like to do. Because one of the things you're going to notice in this scan is that there are stocks that are moving down today. I personally like to trade stocks that are moving in the direction of the market. So I'm going to add a filter. I'm going to add stocks, price actual is greater than. I'm going to go to custom date and value. I'm going to choose 1 day ago. And then I'm going to choose the value of stocks, price, and days high. Now, if I add that into my parameters, now I'm only going to find stocks that are moving up. They're higher than the prior day's high. That's a very bullish pattern. Now, another thing that you could add is you could take out earnings. I don't like to trade stocks that have earnings coming because earnings are very unpredictable. We could do that as well. So under my next parameter, I'll choose stocks, capital appreciation, earnings date, and I'll say earnings date is greater or equal to, let's say, 30 days. That's going to give us at least a month to be in this position before we have to worry about an earnings announcement. So let's go ahead and run the search again. Now, from here, you've had some great tutorials over the last few weeks about some basic VectorVest concepts. Let's go ahead and graph all these. And let's find a stock that we really, really like. Here's Lowe's. Here's Fastenal. Here's CRH. That one looks really, really nice, by the way. It's at a 52-week high. Here's Costco. Costco is approaching a 52-week high. We have CFRUY, we have BBAR, BGNE, MDT, Net Appliance, NetApp. That one looks really, really good too. In fact, let's do this. Let's go to our VectorVest simple layout, and we can see strong RT, rising earnings per share. That looks really, really nice. I'll tell you what, let's focus on NetApp. We'll take a look at that one. So what I want to do now is I want to configure a long call. So I'll go back to my Options Pro software. And again, this is something that you can certainly do in your broker as well. So I'm going to type in NTAP. This is now the option chain for NTAP. If I take a look, I've got an August option at 28, a September at 56 days. I'm simply going to use the September 56-day option. It gives me a little bit more comfort for this. Now, the stock price is currently $80 a share. If I go down to my $80 option, that option is very, very near the money, and that's perfect. So what I'm going to do is I'm going to go out there and look at buying a call. So I'm going to buy one September 15th, 2023 call, and let's take a look at what a risk graph looks like. Now, a risk graph, what that risk graph tells you is how much you will make or lose on the options position. So take a look at this dashed line. If my stock were to rally to 82.50, I would profit $142 on this trade. If the stock were to go to 85, I would go to a $322 profit. That means if I buy the option right now for $365, the stock moves up to $85, I would make $322. I sell the option and I pocket $322. And as you can see, this just goes higher and higher and higher. There is an infinite max profit. Now, the best part about this is there's a limited risk as well. This is only a $365 risk. That's all I can lose on NTAP. If the stock went to 60 tomorrow for some reason, I only lose $365. Now, if I were to go out and simply just buy 100 shares of that stock, well, take a look at the difference. You basically have not an unlimited risk, or not. You can risk up to 8,019 if the stock goes to zero. The option gives you limited risk, which is great. You only have to put up $360 instead of $8,000 to place this trade. Now, a couple things I recommend with the long call. Number one, generally speaking, I don't like to let options expire worthless. Okay? This option has a $360 value. I typically exit the trade if the option price were to decline by half. Right now, we have $3.60 as our premium. What is half of $3.60? It's $1.80. So if you watch this dashed line, if the stock were to fall down and we were to get to about $180 loss, which is right around $76 a share, roughly, in that area. Whoops, that was off a little bit. Right around $76 a share is where that stop would be. I would exit this trade. Salvage the option, salvage your money. Now, where could you exit the trade? Well, we could look at a graph for that. We could follow it with something like Profit Locker. Yes, you can use Profit Locker to do this. The only difference is instead of exiting your trade on a stock, you're going to go to your broker and you are going to exit your option trade. It's the same idea. It is the same idea. So this is a perfect example of NTAP. Now, the advantage of this is, again, you're going to have the most profits. It's infinite. The disadvantage is if you look right here, okay, if the stock goes down, you lose. You're going to be in the red. If the stock goes up, you're in the green. Now, one other thing I want to show you is options have a time decay or theta. So when you're an option buyer, this time decay actually works against you. Let me show you how. If we get halfway to expiration, today it is July 21st. If I move this calendar to August 21st, you see that second line that we just added in there, that dotted line? This is what your P&L would be if the stock were now on August 21st. In order for you to be profitable, the stock would have to be higher than $82.22. Now, if you let this trade go all the way to expiration, that's that solid blue line. At expiration, for you to be profitable, the stock has to be above $83.65. In order to make money on an option when the option expires, you have to what's called overcome the strike price. That means the stock price or the strike price is 80. The premium's $365. This stock has to be over $83.65 at expiration for you to be profitable. So the downside of the long call is the fact that as the trade progresses, that break even or that zero value starts moving to the right. The stock has to continue moving up. Now again, the long call is a very, very good basic options trade, and it works extremely well. Now, to show you a trade that was from last month, I want to do a couple things. Number one, I'm going to go back to VectorVest and I'm going to go to the Unisearch. Now, what I'm going to do is I'm going to back our Unisearch up to June 21st, just 1 month ago from today. We were still in a DEW up. The market was still in a confirmed up at that point. I'm just going to run it back to 621 using the same scan. Now, out of these were all good scans, and these were all good stocks. If I run a quick test, you can see that they all basically went up, with the exception of Wingstop. That stock is down from there. So out of all these stocks, one of the stocks that I really happen to like was Arch Capital. Why do I like Arch Capital? Well, I mean, obviously you can see the stock has gone up since then, but if I go back to 621, okay, RT, not the best, but it's starting to come back up after that retracement. Earnings has been solid this whole time. And again, RT starting to move up. It did have a little bit of a stutter step right there, but nothing serious. Now let's compare two trades. Let's go back to Options Pro, and I have two trades for you. Based off the price of June 21st, we would have bought an August 18th $70 call. It was about a 50-day expiration, and that would have been $4 at the time. You're up $765. That option that was trading at $4 at the time is now trading for about $11 and actually about 12 bucks, let's say. Now take a look at the right. If you'd have just bought 100 shares of Arch Capital on June 21st, yes, the stock did go up $10 a share from there, but it's only up $9.70. Now think about that. If you would have bought Arch Capital, you'd have had to put up $7,000 and you made $9.70. That's still a 10% gain, don't get me wrong, over 10%. But buying the option for $400 has netted you a 200% return on the same trade. Options have a ton of leverage and a lot of benefits to trade instead of just simply trading the stock. So for the long call, again, manage the call like you would a stock trade. Have a stop in place. Have a profit target, whether it's 2 times the premium you bought, a previous high or a previous low. Have a profit target just like you would with a stock. Use a trailing stop if you're not sure what the stop would be. The long call is a very good way of getting into a stock with great amount of leverage and limited risk. Now, the next two trades I want to cover are what I like to call probability trading. This is number one, the covered call, and then number two, the bull put spread. Now, the covered call involves stock purchasing, whereas the bull put spread is solely an options trade. Now, getting back to our basic options terminology, when we are going to sell a call in this instance, because this is the transaction we're going to make, when you sell a call, you have the obligation to sell your shares at a certain price by a certain date. So that means the stock that you own, you have the obligation, if required, to give that stock to somebody else. So let's do this. Let's take a look at that same trade, NTAP, NTAP. So again, I'll choose the September 15th option. It's about 56 days away. That's fine, right around 45 days. Now, what I'm going to do is instead of buying a call, I am going to sell a call and simultaneously purchase the stock. Now, I want you to watch what this does. Remember, with the long call, the stock had to go up for us to make money. So let's do this. I'm going to add a stock leg. I'm going to buy 100 shares of NTAP, and at the same time, I will sell a September 15th. The stock's trading for 80, so I'll pump this up to 82.50 and click OK. Now, what you see here is you see a trade where, take a look at the current price. This is the current price. If now, over the next 56 days, this trade stays absolutely sideways, you will walk away from that trade with a $218 profit. This is adding probability to your trades. That's the beauty here. Now, you're not in a situation where the stock has to move up to make money. And here's the other part. Remember, we talked about time decay. If I move this trade and I simulate it going another month out to August 21st, take a look. Now, instead of that trade costing you, that trade actually benefits you. If we move a month ahead, you can see that our profits will be even more. Now, just like any other stock trade, I would have a stop in place. Maybe look at the graph. Let's take a look at the graph of NTAP. Where do I want to put my stop? Maybe I'll put my stop right at that support level at 77.50. I can exit the trade at 77.50 and maybe lose about $160 on the position. Where would I target my profits? Well, in one hand, you could just let this trade go. On September 15th, as long as the trade or the stock is above 82.50, you will be called away. That simply means that the stock will be taken from you, that option essentially is triggered or assigned, and this trade simply goes away, and you will walk away with a $468 profit. And again, keep it simple. A covered call is no more than the purchase of a stock and the simultaneous sell of a call. We're going to target a call around 45 days to expiration. When in doubt, always go with more time, and one strike above the current stock price. Now, again, this can be altered a little bit if you like a certain stock or a certain strike price, maybe a different expiration, but this is some good basic guidance. And like any other trade, we manage the call, we manage the covered call like you would a stock trade. You're going to have a stop in place, you're going to have an exit target, or in this case, you could simply let the trade get called away. Some of the basic guidance for a covered call would be to take profits at around 80% of your max profit. In this case, $471 would be around a $375 profit target. Now, once you get to that profit target, remember, you can actually continue the trade. This is something that a lot of people that trade options or that haven't traded options don't know. You can simply buy that call back. Remember, calls can be bought and sold anytime you want to. I can sell that call today and buy it back tomorrow and find somebody else to take the obligation. Very, very simple. I can walk away from that trade. Now, if I want to continue the trade because I think NTAP is going to go higher and higher, I can certainly do that. I would just exit that 82.50 call and then I can sell another. So if the stock is trading at $90 and we're getting into September and you want to continue the trade, we can simply exit the September 15th 82.50 call and then possibly sell a October or a November $90 call. And you can just continue the trade moving higher and higher and continue making profits on NTAP. And that call will always provide you some extra comfort zone. And again, the beauty of this trade is in 56 days, as long as you are above $77.90, you will be profitable. This trade is giving you a $3 cushion essentially to be profitable. That's the beauty of what a covered call can do. So finally, I want to talk about my favorite trade, my bread and butter. This is the trade that really is about 95% of the trades that I do are these spreads, and that's the bull put spread. Now, the bull put spread is simply the simultaneous selling and buying a put. We're going to use two different strike prices, but the same expiration. And this, quite frankly, is the cheapest way to add probability to your trades. Because of the limited amount of money that you're going to be putting out, it also has one of the best rates of returns. Now, what we're going to do, and again, I'm giving you some general guidance here. We're going to try to sell an option near 45 days to expiration, giving yourself some cushion to be wrong. Let's take a look at this. So here's NTAP yet again. Now, with NTAP, what we're going to look at is we're going to look at the graph. I generally like to give this a little bit of space to be wrong. So if I'm looking at this graph, I'm looking at the last few bars and I can say, you know what, this is a really big bar right here. How about I put a stop? If I was going to buy 100 shares of NTAP and I wanted a decent stop, I could put my stop right below the prior day's low. That's at about $78.24. Well, if I take a look at the strike prices of the option, I'm going to choose a strike price that's nearest to that price. That low was about $78 and again, right around 30 cents. What I'm going to do now, instead of buying a call, I am going to sell a put. So if I look at the strike prices of my puts, I've got 80, and I'm going to go below. I've got 77.50, 75. Well, I think 77.50 works pretty well. That gives me a nice big buffer to be wrong here. Now, here's what I mean by a nice big buffer. Take a look now at the risk graph of this stock. When I say a buffer to be wrong, that $77.50 price is my stop. This is where I will exit the trade if I am wrong. So, if you take a look at this risk graph gives me the potential to make about $190 on this trade. Now, if you look at the risk, that risk is really scary at $7,560, but that's if the stock goes to zero. We're not going to let the stock go to zero. We're going to exit this trade if we fall below 77.50. What that's going to do is that's going to limit my risk to only about $106. I can make up to $190 with only a $106 risk. And the beauty of this is, if the stock goes sideways, I make money. If the stock goes down with the effects of time decay, just like I showed you on the covered call, I'll push this chart out a month. That time decay, by the next month, if we're still sitting right where we are today, I can make $84. And my break even is moving down. So I'm giving myself more cushion to be wrong here. Now, to me, the scariest part of this trade is that $7,560 lingering over me. So what did we talk about? We talked about a bull put spread. The bull put spread is the simultaneous selling and buying a put. So what I'm going to do is I'm going to go in and I am going to add a purchase of a put. And in this case, I'll choose a $72.50. We'll make it a $5 width. Now, if I do that, this is now what the trade looks like. You have a $115 maximum profit with a $385 max risk. Now, when people look at these bull put spreads, they look at that max profit and max risk and they get scared. Well, why would I want to take a trade that I can only make $115 on, but I'm risking $385? Well, you got to remember, okay, that $385 risk only occurs if the stock, and I want you to follow this dashed line, if the stock drops down to a price of around $65. You really need to be getting out of that trade before that happens. Remember, when you sell this option at $77.50, that is your stop. You're going to let the trade go up, and that's fine. But you're going to exit the trade if it were to fall below $77.50. Now, remember, what is one of the biggest reasons that stocks have these catastrophic huge moves? Earnings. Well, remember what I showed you when we did our scans? I took earnings out of the equation for at least 30 days. You're not going to have to worry about earnings on this stock. It's at least 30 days away. You're going to be out of the trade before an earnings announcement. Now again, you're going to treat this like any other trade. This is the cool part about option spreads, just like a covered call, even just like the long call. This trade changes price every day. Right now, it's trading at $115. Tomorrow, it could be trading at $100. That'd be even better, right? You sold it, you entered the trade, got paid at $115. Now you can exit the trade for $110 and pocket $5. These trades trade like any other instrument. So in this particular instance, I have a maximum profit of $115. And if I exit the trade properly, right at my $77.50 strike, the most I could lose on this trade now is about $52. Now, Ron, what if it gaps? Gaps happen. Out of 50 or 60 trades I place a year using this approach, I might have 2 or 3 that gap. Let's say the stock gaps down to 75. Okay, great. It gaps down to 75. You lost $116. You still have the potential to make $115. Now you lose $116. It's a very rare occurrence. Now, the one thing I want to talk about with these bull put spreads. What is actually happening here? When you sell a put, you are obligated to buy shares at a certain price by a certain date. But remember, only 6% of options actually become a stock transaction. Don't worry. I've been trading options like this for 15 years. I have never needed to perform a stock transaction. There's a reason for that. I exit the trade if the trade surpasses the option strike price that I sold, and I walk away. There's not going to be any obligation to buy. The only obligation that you may have is if you let the trade go too long, that option at 77.50 stays in the money too long, and you just ignore everything. Now, if you were to do that, remember, you also bought a put. So you also have the right to sell the shares. So if I let this trade just completely go against me, it still does have a limited risk, which is great, right? If I just completely ignore the trade and in 56 days the stock is trading at $60, yes, I may be obligated to buy the stock at $77.50. But I also now have the right to sell it at $72.50, limiting my risk to only $5. Now, the beauty of this trade, to place this trade, you will have to put up $387. If your profit target is $100, that's a pretty good ROI. It's a very, very cheap way of entering into the trade. Now, if you remember NetApp on the covered call, well, I can make this a $500 trade too. If I did 5 contracts, I am now entering the trade and getting paid $562, and my maximum risk is still only $19.37. If this trade goes away from me, I have limited risk. Now, instead of having to go out there and buy $8,000 worth of net appliance to make $500, all I've got to put up is $1,900. And remember, you can make up to $562. My risk on the trade is still, at the worst, if I get stopped out properly, about $300. Now, what I'm showing you is really my favorite way, my primary way that I make money as an options trader. Now, if learning how to trade these bull put spreads and also bear call spreads in a bearish market is something that's intriguing you, I am running what's called How to Generate 3% per month with one option trade per week. I have some seminars coming up next week that you are welcome to join to get more information. If you go to www.vectorvest.com/OP-register, I will show you how using these bull put and bear call spreads, you can generate at least 3% per month with as little as one option trade per week. So head to vectorvest.com/OP-register. You'll hit this website right here, click on Reserve My Seat Now, and you'll see that next week we have 3 sessions open to you. Join the session, learn a little bit more about how to do these bull put spreads. It's a trade that every trader should know. Increase your probability, increase your leverage, limit your risk, learn to trade options. Thanks for seeing our tonight's presentation, and I wish you all the best success as we go forward. Thanks again, everyone.